All right, mortgage rates, they just jumped again. Demand is falling. And the big question now is what would happen if this state of affairs just continues? If we just keep going in this direction, if you listened a few episodes ago, I talked about, actually it was entitled Why Mortgage Rates Are Rising and Why It Might Be Temporary. And that is still my hunch that it is temporary. But what if it's not? A big part of this comes down to uncertainty, right? We're not really sure how this whole thing is going to play out. We got geopolitical tensions. There's a war in Iran. We've got global tensions. We've got oil rising. We have all these things I talked about in that last episode. If you haven't listened, definitely check it out because it covers the background of really what I want to talk about today. In that, I kind of discussed what's going on, basically. If you haven't heard it, there was data from the Mortgage Bankers Association that said that the 30-year fixed rate jumped to around 6.4%. Now, it wasn't that long ago that folks could get 5.98, 5.99%. That's a big jump in a very short amount of time. This is just recent in the last month. And it's the highest level since last year. So Mortgage Banker Association, MBA, that's where you get the data. Now, at the same time, I should say, in this last several weeks, mortgage applications also dropped sharply, down 10% week over week. And that's what I talked about before, that it's not just a 1 week move. We've seen now several weeks of this. So you got rates going up, you got demand starting to fall. But what if this continues? I mentioned I think it's going to be temporary, but, we've got to consider both sides of this. We got to consider the idea that this just could keep going. And look, I'm going to go through a few of these scenarios that I think the way it's going to play out. But the first thing you got to imagine is that demand is going to just keep slowing, right? Buyer demand is just, investor demand just naturally slows down. That's something we're already seeing. And keep in mind, too, that higher rates don't just impact new buyers. There's folks that are in the process. There's folks right now who are under contract, who are would-be buyers who, have a pre-approval letter from their mortgage lender just from a few weeks ago. I mean, literally just 3-4 weeks ago, somebody got a pre-approval letter and they're out shopping thinking, oh, great, I'm going to buy this house. This is what I am approved for. And then all of a sudden that debt-to-income ratio significantly changes simply because rates went up a decent amount. So how many of those buyers, would-be buyers, would back out of being under a potential contract or just not qualifying anymore for something they're under contract for, simply because debt-to-income ratio changed so significantly because that mortgage payment went up because the 30-year fixed rate is going up? Remember how this is all tied together. All of this geopolitical tension it's tied to the bond market, which has basically been rising because of oil rising and the expectation that inflation is rising, right? So you got these would-be buyers. They're forced to lower their budget. They got to reconsider, can they even afford to go and move forward? There's the other side of the coin, sellers. Remember that if demand weakens, sellers start to feel that pressure too. So, when you start seeing sellers, they're gonna look at cutting prices. A lot of sellers at this stage, what I think could happen is they may just decide to wait. They may just say, you know what, it's springtime, summer's coming up. That seasonal demand in the summer typically picks up. So what if I just waited for rates to come down and I could maybe get a better price for my home? If rates come down later on and this war tension kind of slows down and the oil stops spiking and, because all these things eventually do come to an end. They always have. I think it's just a matter of when, right? Not if. So why take a lower price today if you're a seller? You might choose to just wait and see conditions improve and put yourself back on the market in a few months when they do. So when you look at those two scenarios, when you look at both sides of the coin, there's always obviously two sides to a negotiation, right? Well, this probably means a slower housing market, I think. I mean, a lot of people are going to say, oh, no, they don't think it's going to impact it. I disagree. I think it will lead to a slower market. And I don't suggest anything like it's a housing crash. I'm just saying less activity. You're just going to see fewer transactions. You're going to see more negotiating. You're going to see things kind of just slow down, and that's normal when you have this type of market. When people come in and they start looking at their 401ks coming down, they see the stock market going down precipitously. They see the news. They see what's going on. They see interest rates spiking. They go to gas up their car and they see that they got to pay a lot more at the pump. And what a worse time that could be when all the spring breakers are out there and everybody's on spring break and here they are traveling and they're seeing, airline tickets go up and gas in your car. This is just not great. It's not great for the psyche of the consumer, for the home buyer, for the investor, right? They're going to pull back. Remember, all of this is tied to inflation, okay? When it hits the pocket of the consumer, that's when it matters. Now, I'm going to go back and tell you, I don't think this will play out like that long term. I do think there will be short-term reverberations. I do. But I also think that oil prices will eventually come down because they always do. Inflation will come down. The bond market will settle down. And then you should see that impact to the 10-year yield kind of just go lower. And that's what mortgage rates typically follow. Look, it's an uncertain time. Global tensions are real. Could it reverse? It sure could. But if it escalates and rates stay higher longer, no, I definitely expect a slowdown. I definitely do. Affordability has already been a challenge, and I talked about that. So where are we at right now? Well, seeing higher rates, weaker demand. We're already seeing that in the numbers. Remember that we're already seeing that in the data in the last 3 to 4 weeks. So the market's already reacting. Question is, does it last or not? I just want to add this one caveat. While there's a case for rates to come down, I'm saying it's not guaranteed. One thing I want to say, in my opinion, I've seen this White House administration in the past. They're willing to push things pretty far from a policy standpoint. We noticed it last year when the president rolled out the tariffs. And I think last year during that whole tariff execution, there was a pretty big reaction to markets. Bond yields moved sharply higher. And the stock market sold off pretty significantly. If you remember, the major indices were down back in April of last year, anywhere from 15 to 20%, depending upon which index, Dow Jones, S&P 500, et cetera. But that's how bad it got. We're not there yet. We're not even there yet. So while I think there's a path for rates to come down, there's also very much a scenario where policy decisions just keep happening where, it impacts global events and just keeps that pressure on the bond market. I don't see why that can't happen. I mean, I certainly have to be open-minded to the possibility. I think we all do. The way I see it, if inflation cools down, bond market settles down, mortgage rates would likely come down. I think that's probably what happens long term. I do believe that. But again, if uncertainty continues and you keep seeing what you're seeing and all this pressure in the system, well, rates could stay higher for longer. I think that's really the key dynamic driving the housing market now. I think it's, something to keep a really close eye on because it is exactly, I don't want to say directly correlated, but it's a big, big contributor to the way the market's reacting and to the housing market and the state of it. That is it for me today. Thank you so much for listening to today's show. And as always, if you have questions or need specific advice, ideas, or just some help regarding your particular real estate needs or situation, or if you're just looking to buy or sell real estate in Florida, well then DM me on Instagram at the Salib Group, or just send me an email to mark@thesalibgroup.com. Don't forget to leave a rating for the show, follow, subscribe, help others find the show, and be informed and educated about the real estate market just like you. Until next time.